Happy Friday, everyone, and welcome back to Open Exchange TV Friday Musings. Jay's sitting there with a smile on his face because he knows his comments from last week have come back to bite him in the bum. How are you, Jay?
Oh man, 100%. Yeah, for those who don't remember last week, I was giving Scott a little grief about constantly being told to put his camera angle better. And so we've had this morning a 15-minute flurry of exercise trying to get Jay on Zoom. So yes, definitely came back to bite me. And it's been that kind of year, Scott. I mean, it's been that kind of year, man. Any time you turn, there's like something else bad happening to your portfolio, and you're like, what the heck, man? So yeah, it's very fitting to talk about the monthly, right? Which is the title, Stability Ahead. So we just need to stabilize our Zoom function and we can move forward.
I tell you what, it's a great piece of technology, but I'm putting this one down to user error. Okay.
Yeah, exactly. And the user error is definitely right here this time. I raised my hand. That was pretty futile. I need my kids. I mean, I need my teenage kids to like help me. That's. I mean, I admit it. I admit it.
All right, so let's get into it then. You mentioned there that the report is turned into a monthly, which is titled "Stability Ahead." Now, with a question mark on the end of it, I should point that out because, like, listen, if you're playing around in mega caps this week, you are not thinking of their stability anywhere. So, why are you titling this "Stability Ahead"?
Well, it is a question mark because I think it's time to bring up the question first of all. So it really came about from a lunch I had with a buddy this week who's a guy in the business, been in the business a long time, and we went to our favorite Chinese food place in Midtown and we sat down and what do you think? How's it going? The usual. And he says, I'm super bearish. I'm expecting Armageddon. And I'm like, Armageddon? I mean, it's been a tough year, but Armageddon is a big word. And I said, so, what are your catalysts? And he said, well, could be anything. And I thought to myself, well, that's a pretty weak answer. I mean, if you're expecting Armageddon, you should be able to like come up with a couple of pretty ugly catalysts. But when I thought about it after the lunch back, in the office, I was like, you know what? After a year like this one, where we've had crises from, Russian invasion hasn't happened since World War II, to energy shocks, to supply chain disruptions, to COVID locking down, 20 million people in Shanghai for months, to inflation, to the Fed having its most aggressive tightening cycle ever, all leading to the worst year for 60-40 portfolio in history. It could be anything. Armageddon could be anything. Who's to say what it will be, right? So that was the catalyst. And I thought to myself as I was getting ready to write the monthly, let's riff off that a little bit and let's think about, if that's where everybody is. And I do think when you look at the bulk of the very few reports that are trying to look ahead, most people are basically saying that, the 2022 action is going to be felt in 2023, right? The Fed tightening cycle, the lag, the earnings collapse, the stock market bottom. People are still pushing that out into 2023 because it hasn't happened in 2022, right? So I at TPW Advisory, we're taking the other side of that, basically. And right. So at the end of it, the monthly became kind of the 2023 outlook piece. And so it's 6,000 words, 24 charts and tables from 16 different research providers. We've talked about this before. This is one of the things that differentiates TPW Advisory. We pull from everywhere. We're synthesizers. And so we've got 16 different research providers whose charts and tables we're using. And we're basically saying that 2023 is going to be a year of stability.
Okay, so let's look into it. And I've obviously had a bit of a preview of your note. What negatives from 2022 could continue rolling through? Like nat gas is obviously a big issue still in Europe, even though prices have dropped back. It's still a hot topic. So what are some of these things that could potentially come through?
Yeah, well, that's exactly right. And we make the point in the monthly that while the price of natural gas in Europe and the price of spot electricity is down 80% or more from its peak, European risk assets are still down from where they were at the peak of the gas price. So, in other words, gas prices shot up, they quadrupled, right, after the invasion. They've subsequently collapsed by 80%. They're roughly at the levels that existed pre Russian invasion. And yet equity prices in the euro are below where they were when those spikes occurred. So there's been no recovery of risk asset prices, even though the big energy spike has completely reversed itself. And so our point would be that, yes, let's say, so everyone again is basically saying, well, okay, we're going to get through this winter. The fear 2 months ago when European assets were getting crushed was that the winter would be horrible and then there wouldn't be enough power and people would be cold and shivering in dark rooms. That's not going to happen. We know that winter is going to be fine. So again, the bearish sentiment just gets pushed out into 2023 and 2024 because next winter is going to be really, really bad. Well, okay, who knows? But and let's accept that European gas prices may go back up a little bit. But are they going to triple again? Are they going to quadruple? Highly unlikely. Let's look at the Fed, right? Fed, most aggressive tightening cycle on record this year, 2022. Could they raise rates next year? Yeah, a little bit. Consensus is that they will in the beginning of the year. Are they going to raise rates 300 basis points, 400 basis points? No. And so the market is fully priced in a terminal rate of 5%. That's priced into equities, that's priced into bonds, that's priced into currencies, commodities right now, today. Will China continue zero COVID? It's quite possible. But will they continue it to the point where they lock down Shanghai again for 2 months? No. We've already seen that the last big city to be locked down, Chengdu, a couple months ago, went through a 2-week lockdown, 2 weeks, not 2 months. So our point is that, yeah, some of these things may still kind of carry on into 2023, but they're highly unlikely to be a shock. They're highly unlikely to be anywhere near as severe as they were this year. And by the way, we've already priced all this into current asset prices. It's in the price. So going forward, if we get a period of stability, as the Fed pauses and decides to assess what things look like, energy prices in Europe stabilize, COVID is COVID in China, supply chains have gotten much better. What does that look like? And what does that look like for markets?
It's so the joy of doing a live show and the drawbacks of doing a live show is we're not on time and so forth. But we've got the drawback actually come in here, Jay. Gents, great show. We seem to be getting through Q3 earnings in a more positive fashion, and the equity market is shrugging a lot of negativity off. Is the bond market on the same page?
Well, I think bonds are driving stocks, right? I mean, bonds have been had the whip hand this year because they're closest to the Fed. And so it's no surprise to us that you've had the stock decent environment in October has come about with rates coming in considerably, right? I mean, the 10-year is back under 4%. It was at 4.35 2 weeks ago. The 2-year is at 4.35. It was at 4.60 a couple weeks ago. So I think we had that big worry about systemic shocks with the UK and people selling their treasuries to support the yen, and there was every idea under the sun as to why things were happening because it was so confusing. But all that has ebbed, and now we're in a much better spot. And we wrote our piece onto earnings, right? I mean, we talked about that 3 or 4 weeks ago. We talked about extrapolation. That was last monthly, and said that we think the period of extrapolating ever higher inflation, ever higher rates, ever more aggressive Fed is ending. We then talked about two-sided markets, right? You have to look at both sides, not just the downside, but the upside. We've seen that play out. And we wrote about on to earnings, right? We talked about Bill Belichick and the famous on to Cincinnati for the Patriots. Okay, on to earnings. And guess what? Earnings have been fine. We've been talking about that. We talked about it in Q2. High nominal growth. When you have 8% nominal growth in the US, as we do, and earnings consensus is for 2% earnings gain, that's not a high bar. And by the way, earnings are better in Europe. Europe earnings are running, JP Morgan just put out their Q3 earnings report this morning. Europe earnings are running 5% ahead of last year. We just talked about Europe and gas and everything else. Earnings are up in Europe. In Japan, which a market nobody talks about, except the yen is imploding and it's a disaster and blah blah blah. Earnings in Japan, Scott, are running 22% ahead of year ago levels. 20% year over year earnings growth in Japan, one of the cheapest markets in the world, breaking out, by the way, as we show in the monthly. If you're at all interested in Japan, people out there, take down the monthly, pull the whole thing down, look at the charts. We show a chart in there. Japan is breaking out versus the S&P over a long 30-year chart. So there's a lot of action. And we think that the big key is the dollar, right? The dollar has been a major beneficiary of all this uncertainty, major beneficiary of the Fed being most aggressive, major beneficiary of US rates being much higher than the rest of the world. As a result, dollar's had its best year in 20 years this year. We think the dollar's the big loser from stability. And so we think the dollar rolling over, which we think it's in the process of starting to do, it's super expensive versus all the developed economies, 40% overvalued versus the euro, 40% overvalued versus the yen, 40%. The dollar is the big loser from stability. Dollar rollover means a tailwind for non-US risk assets like equities, right? Tailwind for emerging market debt, which we talked about, we like, and a tailwind for commodities, which we've been enthusiastic about commodities all year. And so we continue to be. So that's our big call, is that stability is coming, that the crises of 2022 will not extend into 2023, and that the big loser from stability is the dollar, which means, conversely, the big winners are probably going to be outside the United States. And you talked about the mega caps struggling this week. Big tech going ex growth is a major anchor on the US equity market relative to the rest of the world.
Okay, so let's get back to that. Was a great question, and I gave you plenty of room to work with, which is great.
You did, and I took it. Thank you.
So your monthly breaks down five different sectors: climate, economics, politics, policy, and markets. Now let's fine tune it down a little bit today, because obviously you just had, as I said, plenty of room to work with that last question. I want to focus in the first one on politics. Now, you mentioned Monty Python's sketchbook in the United Kingdom. Funny enough, Mehdi talked about that on Wednesday and threw some Benny Hill music in the back of it as well.
Oh, nice.
Give us a rundown on the politics thoughts on it.
Well, I'm not surprised that the brilliant Mehdi is ahead of me by a couple of days with my Monty Python reference. But yeah, the UK politics, what else are you going to talk about but Monty Python, right? Absolutely crazy. The thing that I love the most is how there have been some clips on Twitter about the Republican hangers-on, the Larry Kudlows and Stephen Moores of the world, who are caught in these clips praising Liz Truss's policy mix to the skies, calling it Reagan-esque and saying it's something the U.S. Republican Party ought to run on in 2024. Just classic stuff. So you want to talk about Benny Hill, just watch Larry Kudlow talking about how wonderful Liz Truss's policies are. It's classic. So that's one. We have the midterms in the US. I think it's in the price. The bigger point is that every year, doesn't matter. And again, chart is in the monthly. Every year, doesn't matter which party is in power. Every year post the midterms is an up year for the S&P. Pretty amazing stat. And one of the things about the return to normalcy, relatively speaking, right, is that things like history and seasonality and models start to become useful again. One of the real challenges, I think, for investors the last couple of years is that we've been in an ahistorical period. You know, COVID, 100-year, pandemic, most aggressive tightening cycle ever. Been a lot of ahistorical things, and that has meant seasonality and history and models have been really challenged, right? Because it's ahistorical. We don't have back history for this type of an environment. So now we think one of the interesting kind of subtexts is we think that if we get back to normalcy or some level, some version thereof, the 2020 versions of normalcy, a much more sped up world for sure, is that you can use some of these things. So midterm in the US, big point is that every year after has been an up year. Okay, that's point one. In the politics, the UK situation, for us, it's basically a manifestation of Brexit. Post-Brexit, the UK is a small island economy. That's it. Relatively unimportant. It's not a big deal. It's a big deal for them, but not for the rest of the world. And then, of course, you have to talk about China with the post-PPC market reaction on Monday and continuing. KWEB is down 4% today, I saw earlier. KWEB, the China Internet ETF, was down 15% on Monday. And I don't really get that. I think it's a gross overreaction. So President Xi is going to have his third term. Everybody knew that. He put his people into the 7-member standing committee of the Politburo. Who was surprised? I mean, we're really surprised at that. The guy's third term, and he gets to put his own people in there. I mean, and so the thesis being that those people are going to then crash the economy, which the whole deal in China is that you don't pay attention to politics if we take care of the economy, right? So these guys are going to crush the economy, which their whole power base depends on. It doesn't make any sense to me. And at the end of the day, guess what? Alibaba, Tencent are trading at 1x sales. 1x sales, okay? They're buying back stock like it's nobody's business. They're increasing their buybacks virtually on a daily basis. They sell at 1x sales in an economy that's growing at 4% per annum, right? The Q3 numbers just came out. China's GDP grew at a 4% annualized rate. US just came out growing at a 2% annualized rate, 2.5%. So the big cap techs in the US are still selling 6, 7, 8x sales. The big cap techs in China, post PPC, post the politics, selling at 1x sales. We think politically, and then of course, to finish up finally, we have the Brazilian runoff elections this weekend. So just like in every other space, there's just an absolute ton of activity. We think in 2023, much of that is going to be much less impactful for risk assets.
Okay, and then the last thing that we're going to cover in the review is markets. Now, there's a couple of dirty words we've got to throw in there, like inflation, recession fears. Like, how do you think this is going to impact all the markets, and where do you think we go for 23?
Well, I mean, near term, as we talked about it, right? We've been on the earnings kick. We've been on the two-sided market kick. We've been talking about this stuff for weeks already at TPW Advisory. So we're not at all surprised by the market rebound here. We think it makes a lot of sense. The market is priced in a uber aggressive Fed getting to 5%. It's in the price. The market is pricing in a economy that is slowing, pricing in earnings growth of a couple of percent. So I think everything is kind of set up, and we're now, as we just talked about, approaching the seasonally best time of the year. Again, we have a chart in there. Kevin Muir of Macro Tourist fame put a piece out this week showing going back 40 years, the best day, the absolute best day to buy for the year-end rally is October 31st. 44 days out from the end of the year. Okay, again, chart is in the monthly. So we're not surprised that that's our base case. We think we're going higher. Markets, bottoms are a process, not a date. As time passes, we continue to feel like we're building a bottom. Again, market not able to break through 3,600. It's had multiple attempts to do so. Now priced in the Fed, now priced in low earnings growth. So we see potential for markets to move higher, both near term and medium term. So thus over the course of 2023. As we talked about, the dollar is the big loser from stability. We expect stability to kind of return in 2023. That dollar weakness means we want to be focused on non-US markets. And we're focused both on EFA and emerging. We talked about Japan, 20% earnings growth, one of the cheapest markets out there, breaking out against the US S&P. We like Brazil. We talked about Brazil before. We have the elections. If Lula wins, when Lula won last time, his first victory, it was one of the all-time best buying opportunities for Brazil. I don't expect this one to be as good, but Brazil sells at 6 times earnings. Six times earnings, okay? Their central bank has finished its rate hiking cycle. They have real rates of about 4 to 5%. Inflation just came in the other day at about 8%, give or take, in Brazil. Their government paper yields 13%. Currency is absolutely fine, probably should rally considerably. So there's Brazil. We like Southeast Asia as well in the emerging markets. And so we think the opportunities are non-US. We think the opportunities in the US are cyclical in value. We continue to love energy, continue to really like financials. Energy is the new leader, clearly, right? Energy is driving the train here as big tech rolls over. And by the way, big tech rolls over, where are people going to go for growth? So small cap growth is massively outperforming big cap growth, okay? Pull up the chart, definitely happening. Where we participate there is in our thematic work. Remember, we have our global multi-asset model and our TPW20 model. TPW20 thematic focus, climate and innovation. We think that climate is driving, is the big global macro theme for this decade. So opportunities continue to be there. And in the innovation space, as big cap tech goes X growth, small cap tech, small cap growth can take that mantle of leadership, and any money whatsoever going in there is going to push those things up. So we like that space. In fixed income, we like credit. We're not fans of sovereign because of our high nominal growth world expectation. We think high nominal growth means that high yield is fine because you're not going to have a default cycle. And by the way, there's been absolutely, the high yield companies refinanced aggressively in 2020 and 2021. What does that mean? It means that there's no refi mountain until 2025, which means that they can absorb a year like this one where rates back up. Again, chart is in the monthly. So we like US high yield, we like emerging market local currency credit, like we talked about with Brazil. And then finally, commodities, we're overweight in our global multi-asset model. Inventories are very limited. Talk about oil gets a lot of attention, but we have a nice little clip in the monthly about copper. Copper inventories in China are at rock bottom levels. If there's any pickup in Chinese economic activity, copper prices are going to pick up dramatically, which means miners are going to pick up. Their stock prices are going to pick up dramatically. And we have exposure there, significant exposure in our global multi-asset model. So bottom line, Scott, we think a year of stability is going to follow this year of crisis that we've had. We think the dollar is the big loser in that stability. We think non-US equities, commodities are going to be the big winners. And that's where we're focusing our attention, both in our global multi-asset model and in our TPW20 thematic model. Our focus there is on climate. We didn't really touch on climate in this conversation, but we actually have quite a bit in the monthly on climate. the spending that's happening and is going to happen in the next couple of years to deal with clean energy and climate change is going to be off the charts, and investors need to pay attention. We have 40% of our TPW20 thematic model has climate exposure. That's a big play for us, and we think it's going to do really well in the next couple of years.
Yeah. All right, listen, Jay, before we wrap up here, I want to bring up one little stat here, which is a little bit contradictory to what you have, but it probably doesn't fit into the financial model. So the World Series is starting, and we know who's in it. It's Philly and Houston. Over the past 100 years, the surest sign of an oncoming financial crisis has been a Philadelphia-based baseball team winning the World Series. In 1929, they were known as the Athletics. They won the World Series. Market turned to bad over the next 2
Yeah, we know that. Yeah.
1980, the Phillies won the World Series. That wasn't a good time either. And in 2008, the Phillies won the World Series. But the market did recover really hard after that, obviously, as we all know. 2022, what's going to happen, Jay?
Yeah. Hey, Scott, I mean, you're catching me off guard here. I thought for sure there was going to be a football conversation here because we've talked about football, and I was like, well, Duke's off this week, so there's no Duke game. So what is he going to ask me? And you hit me with a baseball question. I'm a Red Sox fan, so it's been a horrible year. I have no view. I have no insight. I mean, I watched a little bit of the Astros dismantling of the Yankees, so they were pretty tough to beat. And that's probably where, given my view of stability and your history of what happens when the Phillies win, I'm picking the Astros.
Yeah, I saw it on a tweet, and underneath it said everyone should be a fan in the World Series for Houston. So,
yeah, I guess so.
Well, Jay, you have a great, relaxing weekend, seeing as though Duke's not playing football this weekend, and we'll be talking to you again next week.
All right, Scott. Sorry for the problems with the technology earlier, but glad we got the show done. And this monthly's a good one. I mean, there's a whole lot in there. So, folks, you can get the executive summary up on the Nucleus site. You can get this video, but the full Monty, the piece itself is really worth digging into if you're interested in a different point of view than the consensus for 2023.
And correct me if I'm wrong, your website is jpelosky.com?
Yep, jpelosky at pelosky.com.
Yeah, pelosky.com. All right.
Yeah.
Fantastic. Well, once again, have a great weekend. And for everyone else, good luck investing.